Well, here we are in the pre-show mode. Welcome to the pre-show conversation before we get into the main show in a couple of moments. Great to have you on board. Lots of comments in the chat. Lots of people discussing Nuggets news, which we might touch on if we get time a bit later. Cost of housing around the traps. Is renting better than buying? What's the Reserve Bank going to do? A whole lot of things. Very interesting conversation. And it's just me tonight, so you can ask me whatever you like as we go forward, and I'll try and give you some thoughts about what I'm seeing and what I'm not seeing and what rubbish is being spruiked and who's spruiking it and why and all those good things. So it's good to have you on board. Please do like the show if you have not done so already. It really does help to get this propagated out over YouTube. So it really is quite worthwhile to do. And with all of these things, of course, there will be way too many questions and way too many comments for me to cover them all, but we will try and do what we can. Hi to George. Thanks, George. Good to see you on. We must finish our rabbit hole series soon, mustn't we? Don't just follow the crowd. Good advice, I think. And Cookie Boy's talking about the wealth effect. Yeah, the wealth effect's interesting, you know. Is it real? Is it imaginary? Well, we'll talk about that perhaps a bit later. Anyway, I reckon that's enough pre-show, so let me take that off. I'm going to run the titles and then we'll get on with the main game. Stand by. Well, good evening and welcome to this live show on the 3rd of August 2021. Martin North here from Digital Finance Analytics. Great to have you on board. And thanks very much for taking some time out on your Tuesday evening to spend it with me. It's great to have you there. Good to see some new names as well as some of the old favourites. And as always, there'll be plenty of time to explore issues that you'd like to this evening as we go forward. What I'm going to do is my normal introduction and conversation stoppers in terms of the show, the information, and then we'll get into questions a bit later. So on that basis, let me just switch over. And I don't know whether you like the slightly stern look that I recorded the other day for my thumbnail, but that's how I felt at the time. And frankly, things have not got much better since, so I may change it for next time. But there you go. Now, just in terms of the running order, this introduction starts and then we'll do the house rules quickly, talk about our models briefly. Just a few key slides, in fact, quite a lot of key slides tonight because Cookie Boy's been busy throwing me stuff, so thanks, Cookie, for that. And then some questions and answers. The main part of the show will be questions and answers. I do have the postcode engine online, by the way. If you're interested in a particular postcode, we can perhaps do that too. And we'll sign off about 9:30, give or take, Cookie was suggesting we need to go to 10 o'clock. Well, maybe, but I ran out of steam at about 9:30 generally. In terms of the house rules, as always, this isn't financial advice. I have to underscore this every time. Don't know your individual circumstances. I'm just making general comments based on my analysis, my views of what's going on. If you need financial advice, please go find a financial advisor, and don't try and read across from what I'm saying. Do play nice in the chat room, no racial slurs. We do moderate the stream. We do turn people off if they get antsy. But I do encourage everybody to chat in the stream and make whatever points you want to make. And if you have specific questions, then it's good to use @walk the world to get my attention. And just to say, this is on the 3rd of August if you're watching this in replay. I've also enabled Super Chat, and that allows you to get your question to the top of the queue, and also, if you like, make a donation to us and to help cover some of the costs of the things that we do here. Now, just quickly, for those who perhaps haven't been involved in these conversations before, this is my core market model. Very important to understand that I don't just make stuff up. This is based off survey information and modelling. We survey households all the time, 52,000 households. Put them into the core market model, and that allows us to slice and dice the data. We can look at it through various dimensions, from location through to different segments, and we can look at property information and other financial information and a bunch of other stuff around our households. And we can also think about the scenarios and how that plays out ahead of time. Very important at the moment because, of course, there are so many moving parts to what's going on. And we can also then look at mortgage stress, price trajectory information, the buying and selling intentions, the migration statistics, the economics, CPI, wages and employment, bung it in the core market model through our scenarios. And that gives us a view of price movements, projections, ideas of where things might go at a postcode level or rolled up to state, regional, Australia level. And, these are indicative only, but it gives you a bit of a flavour of what I'm seeing. Just the other thing to say on that is I do use that information in my one-on-one service. If you're interested in having a one-to-one conversation with me about a particular suburb, we can do that. I can look at the stress data, the price data, and also think about where the trends may be going based on the modelling. And you can book a time with me by Zoom or indeed phone discussion up to an hour. There's a fee involved simply because it takes a lot of work to prepare. And at the moment we're booking 3 to 5 weeks ahead. If you're interested in that, just send me a message via the DFA blog, and we can sort something out. Now let's talk about the RBA, who held, or once again, at its meeting today, the board decided to maintain the cash rate, maintain the 10 basis points on the government bond, and continue the purchase securities at 5 billion a week until September, and then taper to 4 billion. Now, that was very interesting because there were a lot of people who thought that the RBA would have actually upped their bond purchases. Westpac was advocating 6 billion because of all the lockdowns, but the RBA was unmoved, so we're still back here with where we are. They're still looking to taper. Watch to see whether that changes later. It may not. They basically said the recovery is better than expected. There's significant additional policy support, and the vaccine program will also help in the recovery once the virus outbreaks are contained. Now, that's, of course, the caveat. When will they? How will they be? It's a big question, I think. And also, just in saying that they are also underscoring the uncertainty in the coming months, but the central scenario is the economy to grow a little over 4% over 2022 and by 2.5% over 2023. So a bit of an up and then a down. And that's based on the assumption of high vaccination rates and a gradual opening up. There are other scenarios, of course. And in terms of the labour market, they're basically looking at a 4.25% employment rate at the end of 2022 and 4% by the end of 2023. Keep your fingers crossed if that happens. I'm not sure that it will. They're also talking about CPI, spikes at 3.8, but the underlying inflation is at 1.75. Depends, of course, on how you measure it, as we've discussed a few times. Depends on what's included, what's not included, and what should be included. And, of course, we know that a lot of housing costs are not included in that. So, in a way, what they're measuring is probably the wrong thing anyway. And they're talking about a pickup in wages and underlying inflation, but it will only be gradual. And they're basically talking about the inflation to be 1.75 over 2022, 2.25 over 2023, and again, the behaviour of wages and prices at low levels of forecast unemployment is one of the unknown questions. And they're also talking about the housing market continuing to strengthen with prices rising in all major markets, housing credit picked up, etc., etc. So in a way, not too much to talk about. Accommodative financial conditions, committed to maintaining highly accommodative monetary conditions, and they weren't really both the rate for a long time yet. So look, there was nothing really much new in this from my perspective. It was like they just dusted off last month and said the same stuff again, really. Despite the fact that we're in a very different situation than we were a month ago, particularly with the Sydney lockdowns and now lockdowns in Queensland. And though, of course, Victoria and SA is looking a lot better at the moment. So uncertain times is my summary of what I'm seeing. And to my mind, the RBA wasn't necessarily reflecting the latest information that we're seeing, but I guess they can do that next month. Will a month make a difference? Not hugely, I suspect. Now, the other interesting thing was that, as I mentioned, Westpac came out before the meeting to say that they expect the unemployment rate to reach 4.8%, and they're also talking about an increase in bond purchases, but no, that didn't happen. And Cookie Boy sent me this basically from the US. They're talking about the 1.8 million homeowners still in forbearance as the safety net is removed. 1/5 of them will not be able to extend their forbearance past September, and there is potential for Congress intervention. But, this isn't just an Australian thing. We are seeing pressure on households, particularly with mortgages, in many different countries, including the US. And it's interesting that in New Zealand, the Reserve Bank came out today to say they're going to consider tightening mortgage lending standards, and they're talking about consulting to implement debt-to-income restrictions and also looking to taper back high loan-to-value lending. Now, they are definitely addressing more quickly than RBA some of these issues. You'd also have to say that their house prices are even hotter than ours, so they need probably to do stuff sooner. And of course, they don't have the COVID to deal with at the moment in the same way that we do. But that was quite an interesting conversation from the Reserve Bank in New Zealand. And it sort of makes the point that they are, on one hand, trying to keep the economy moving, but also trying to tighten some of their monetary policy. Interesting contention between those two. Now, new home loans commitments fell. This is data today from the ABS, 1.6%. Owner-occupied housing fell 2.5% in June, still 76% higher than a year ago. And the largest fall was a 70% reduction in commitments for the construction of new dwellings as home builder ends. And there was no growth in lending for the purchase of existing dwellings. So you can see the impact. When government stimulus is withdrawn, then lending weakens. And the point to understand here is that the whole housing market and the construction sector are absolutely propped up by incentives and stimulus from the government and very low levels of interest rates. And that means that we are going to see movements in lending based very much on the demand off the back of that. But it's interesting that that's actually a significant fall. And another one, which is also quite interesting, that dwelling approvals dropped 6.7% in June. And that's the third consecutive month, following a 7.6% fall in May and a 5% fall in April. And as part of that, this is very, again, significant 11.8% fall in private sector houses. And of course, that is very much reflecting the removal of the government stimulus. Once again, the home builder package. So you can see the direct correlation between government policy and movements in that data. And I have to say that, you've got to expect the government to come in and do another home builder, because that is pretty much the only game in town in terms of trying to keep the economy going through the COVID momentum. So watch and see. I wouldn't be surprised at all if they do that. It's also worth just making this point. This came out again today, that there were 60,000 people who departed Sydney and Melbourne to other parts of the country in the 12 months to March 2021. More than 32 moved from Melbourne, and Sydney lost 31,600 to other parts of the country. And of course, many of those went up to Queensland, as well as some of the other states over to the west and into Tassie. And there's a bit of rebalancing going on, but it also is having a significant impact on the rental markets, particularly in the regions. So we're seeing a very tight rental market in the regions, but a very loose rental market closer into the city. And that's something else to bear in mind when we actually look at the individual data sets, as we will a bit later. Now, SQM made the point that the listings had dropped dramatically, and in fact you can see there that listings were down significantly in Hobart and Canberra and Brisbane, as well as Sydney and Melbourne. And so there's a significant national fall. And changes in values from CoreLogic showed, again, a considerable rise through July. A national move across Australia in the last month of 1.6%, over 5.9% over the past 3 months, and 16.1% on average. But you can see the different variations there between different locations, the regional centres, and Australia overall. So it's a patchwork quilt, really, in terms of what's happening. WA, interesting to note, regional WA down over the last month, down over the quarter, and only 5.5% over the last 12 months. And Perth only up 0.3, 1.6 over 3 months, and 10.8% over the last 12 months. And it's slowing. The key point to make is that this momentum in prices is definitely easing back at the moment. Now, of course, that got a lot of the journalists excited. House price gains reach a 17-year high. Yeah. Well, what would you expect given all that stimulus? And low rates brings home high interest. So quoting all of those significant sales. Now, let me just make the point here. These are mostly standalone properties on large plots in particular areas. This is not a uniform pattern across the country, and it certainly doesn't include what's going on in the unit sector. And once again, the journalists are being very selective in the story they tell. They're not actually including the unit information, which they should be. Now, Roy Morgan published their confidence metric again today. It rebounded very slightly, up 1.1% after Victoria and South Australia lifted their lockdowns, but a lot of the others are still negative, and it's way below where it was in terms of the previous trend. And my expectation is that we're going to see more weakness in confidence, particularly as the virus issues continue to bounce around. Now, I did recall talking about this last time, but I wanted just to stress it again. I did a show just over a month ago called The Housing Elephant in the Room and What to Do About It, and wanted to make the point that so much of the economy is housing and construction related. And we're seeing now, with the downturns in some of those leading metrics, that this could have a significant negative impact on the broader economy, in my view. That set up, mortgage applications are up by a third, according to some, claiming that things are booming. Well, we'll see. I'm not necessarily seeing that in my data the same way. Interestingly, the discussion here was specifically talking about June rather than July, and I think you'll find that demand is softening. They did sort of recognise that in the article as well. And this is quite disturbing, because the thought is that maybe New South Wales will have a couple of hundred COVID cases a day for months. So we're going to go grinding on, and they'll be pushing the vaccines quite hard, but no exit strategy. Now, if that's the case, that's going to have a very negative impact on the economy. And of course, there are a number of people now talking about a potential recession, in other words, 2 negative quarters of growth. Others saying, no, the growth we had beforehand will be sufficient to offset it. So on an annualised basis, we won't necessarily hit recession. I think we're not sure yet how it's going to play out, but it's pretty negative, and it's certainly flowing through into my statistics as well, as I'll show in a second. Now, interestingly, Westpac's now rolled out support for Queenslanders as well, and of course the banks are getting support from APRA. They're being allowed to classify any postponed loans as loans in order, which means they don't necessarily have to declare them the same way as they would otherwise. And we're back to where we were, really, with this holding pattern where the banks are being encouraged to provide some support. Although, as I made in the show yesterday, I highlighted the fact the level of support from government at the moment is much lower than it was last year. And as a result of that, a lot more people are in difficulty, and that's coming through in my data. Mortgage deferrals, though, should be a last resort, says ANZ. Mortgage repayments should be the last resort for borrowers in financial hardship, according to ANZ. The bank said while it's prepared to help struggling borrowers, mortgage deferrals are no longer the first or best option. Now, that's very interesting. Every customer's circumstances are different, and the deferral may not be the best option for some of them. That's because money still has to be repaid, so there could be implications for their credit status down the track. This is very important for people to understand. If you do defer, there are consequences. And bear in mind this time that banks aren't extending the mortgage duration further. So when you come back to make those mortgage repayments, even if rates haven't moved, you will have to pay more. So this is not necessarily a particularly healthy story. And ANZ said that about 3/4 of recent applications for home loan assistance had come from New South Wales, but the level is still well below where it was previously. Well, of course, it's been running for a month, so what do you expect? Now, let me turn to mortgage stress, as I always report in these shows. And unfortunately, it's moved up again. It's to 41.7. It was 41 and a bit before. Not dramatically higher, but significantly higher and nevertheless. And the latest data from the RBA showed that the household debt ratio was now up to 180.9, so it's moving back up again. And you can see the trend there. It did come down, and that's of course because interest rates dropped, and people repaid a lot of mortgages earlier on. That's now turning around. The average mortgage is a lot bigger than it used to be. And we can look in detail at the latest statistics. This is July, and I will just point out a few statistics. I'm not going to spend long on this because we could spend the whole of the show on it, but this is the interesting one. New South Wales stress 40.15 compared with 38.62 last month. Now that's quite an interesting jump insofar that we had 418,000 and it's now 444,000 households registering mortgage stress. Now, just to be clear, I register mortgage stress when people's cash flow is negative. In other words, money coming in isn't sufficient to cover their outgoings and their mortgage. Now, that's a relatively broad way of thinking about it, but if you think of it in cash flow terms, if you don't have enough money coming in to cover all your costs, sure, you can draw down on deposits, you can potentially pull on credit. But if you don't have those, then you've got an issue. And if you keep doing that, then you get into financial difficulty. So that shift is quite significant in terms of the relative movement between June and July, and it's all down to the lockdowns. In terms of some of the other states, Tasmania is still there at 56.5. And interestingly, you can see that's gone up from 50.16 to 56.5. And that's from 43,680 up to 40. So from 43 in July was 41 in June. So you can see there that there's quite a big move up. And pretty much wherever you look, actually, you can see there that the numbers are looking pretty troublesome. Apart from WA, WA had 40% of households in stress in June. In July, that was down to 39.57, so it dropped a bit. And in terms of numbers, just over 200,000 there. Just over 200,000 there. And that was 198. So the point to make here is that there are more people who are actually holding properties, and the total number rose, but the percentage dropped slightly. So that's due to the fact that more people are taking a mortgage, and that's all to do with those stimulus packages. Now, if you look at rental stress, it's not particularly positive either. 38.8% of households in mortgage stress, compared with 37.96, so a small rise, and pretty much across the board. Investor stress is at 25% this time around, compared with 25.9, so not a lot of difference, and that's because there has been a little bit more uptake of some rentals, and some investors have been able to shed people with paying low rents and getting people paying slightly higher rents. But the overall financial stress metrics, which is the indicated amalgamation of all of those categories, is sitting at 39.34% of households, compared with 39.45. So not a huge amount overall, but these patches, particularly of mortgage stress in Sydney, is very significant. Now, if I then look at it by segment, just quickly, there's no real dramatic change, but again, you can see there that in terms of mortgage stress, younger families have the highest level of mortgage stress at 78%. We also have some other groups, the battling urban and the disadvantaged fringe. And then we have a few others as well there, which are not necessarily doing that well. And if you look at it in just pure number terms, I keep having to highlight this point, we do see a lot of suburban mainstreams. In fact, the largest group in terms of mortgage stress, disadvantaged fringe at 422,000, but look, suburban mainstream 231,000, just a little bit behind the 247,000 young growing families. So it is significant and widespread. It's a tapestry, as I keep saying. If we then look at the mortgage stress by top postcodes, and I've just sorted them, this is sorted by the number in stress rather than the percentage in mortgage stress. And you can see there that we've got Western Australia at the top of the list, then Narra Warren, then Toowoomba, then Berwick and Harkaway, then Ballarat, then Pakenham, Mount Annan, Cranbourne, Derwent, and so it goes on. So most of these are high-growth, new development suburbs where there's been a lot of new development, where there's a lot of new land and home packages still being sold, and a lot of people with large mortgages, often first-generation migrants, and often struggling with those repayments. So in a way, not a lot of change, but also just repeating what I've seen before in terms of where the problems are. If I then go to rental stress, and again, it's pretty much same old, same old. St George's Basin, those areas on the south coast, definitely a significant area, big area of course, but then Surfers Paradise up in Queensland, then Wentworthville and Westmead over in Western Sydney, then Toowoomba, and so it goes on, Mount Druitt, West Gosford up in the central coast, and then coming into Sydney, so around Millers Point and Dawes Point and the Haymarket around there, significant number there, and so it goes on. And again, it's sorted by the number in rental stress. And rental stress is significant insofar that a lot of people who are renting are actually in fragmented part-time jobs. And what that basically means is that when the lockdowns happen, those jobs disappear. And they could be waiting at tables, or they could be doing part-time retail work. They just disappear. And that's what we see quite a lot of. So there's a lot of stress close into the centres of towns. And interestingly, some people now have decided to move back with parents, and we are seeing a number of renters giving up and just moving in. So that's another factor to bear in mind. Interesting to see when the ABS is run on the 10th of August, and we get the results later in the year, what the multi-household story is. Have we seen a significant migration into multi-generational properties? It'd be interesting to get that data. If I then look at the stressed investors, again, this is where the properties are, not necessarily where the investors live, but you can see there that central Melbourne is a real problem, a lot of vacant properties there, as is up in Queensland as well. So it does vary a little bit, but again, you can see places like Surrey Hills and Darlinghurst. You can see also places like Paradise Point in Queensland and Southport in Queensland, interestingly. A lot of interesting situations there. A lot of people have bought investment properties up in Queensland, but they're not necessarily getting what they thought they were going to get in terms of the returns. And interestingly, of course, we're finding that some people there are also struggling now with the lockdowns and with the lack of ability to pay rents. And places like St Kilda and South Bank are very much on the map as well, so close into the centre of towns, and we're seeing that both in Sydney and Melbourne. If I then go to look at financial stress, which is the sort of top-level aggregate measure, you can see there that Toowoomba sits there at the top, then central Melbourne, then we've got Mount Druitt, Western Sydney, and then we've got Hoppers Crossing and Point Cook and Werribee, Cranbourne, so those high-growth corridors, Narra Warren, places like that. Then we've got Tamworth there as well, then Greystanes, Blacktown, Ballarat, Belwood Park, West Gosford. So the point is, you can see that some of the same names keep popping up, but you can also see how it does vary a little bit by different category. But the overall story here is there are still households who are really struggling with the flows of cash and the demand on their ability to pay for their mortgage and their rent and everything else. And more property investors in my surveys are still thinking of listing their properties and trying to get out while they can, thinking that maybe prices won't be rising so much ahead. So that's the other factor to bear in mind. Now, we can just briefly look at some stress mapping, which is something that I do quite like to do. So here is the mortgage stress. Now, today I'm showing the stress data by count rather than by percentage. It just gives you a different view, and you can see there that the bluey ones are the lowest counts and the orangey and reddy ones are the highest counts. So we'll just pull out a little bit from the centre of Sydney, and you can see there that around the harbour, well, there are a few areas like around Bondi Beach and Randwick where there's a bit more stress. Not dramatically so, but a bit around more in Mossman. Then we got to Lane Cove and Willoughby, places like that. Whereas closer in, it's not quite as bad. Some of the inner suburbs doing okay. But then if you pull out a bit further, and this is where it gets really interesting, right? I want to pull out to those areas that are actually locked down at the moment. So places like Fairfield. Because I want to draw your attention to this rather important point, that there is a very significant correlation between some of the higher stressed areas and those where there are more people with the virus. And I think it's connected, because I think that people are actually having to work to try and keep their heads above water. And the numbers we're talking about, around here and close to Campbelltown and Fairfield are big numbers. You can see there that it's 8,000 and above here. You can see that the others are slightly lower. But that's a very significant factor which I think people should be conscious of, right? This is definitely, there is a correlation, and you can see it standing out quite clearly on the map as you pull out a bit further. I'll also make the point that Campbelltown is also there as well, and that may be no great surprise. So that's where a lot of the pressure is. And a lot of that pressure is to do with multiple migrants coming into the area, lots of home and land packages, lots of high growth corridors, lots of people in part-time fragmented work, and in many cases also quite large families too. So all of those factors are in play. Now, I will do the same thing just over from Melbourne, just to give you a little bit of a relative view. And again, we'll start in the centre of town. Let's get rid of that. And we'll pull out a little bit. And you can see a somewhat similar story insofar that closer into Melbourne there are a few areas. Some of the Docklands areas in Port Melbourne, a bit more pressure. But as you pull out, you can see that if you go north, up towards Moonee Ponds and Moonee Valley, you've got issues. And if you pull out further, you start then seeing the same trends. You start seeing the more orangey, reddy things going on. And if you pull out even further, you can again see the old problem of those high growth corridors around Wyndham, and even down here in the Dandenongs and beyond there as well. So there's some interesting correlations once again, and the large numbers of households we're talking about here are pretty significant. Right, I'm just going to do one more on the stress view, which is, let's go to 6,000. Okay, so I'm now in Perth, and again the story here is not quite as bad, but again the point I want to make is there are some pockets like Churchlands, for example, where there are more people registering cash flow issues. And I had an interesting discussion with a couple of journalists writing on the West, and they, well, it can't, how can that be? How can these people up here, these are more relatively well-off people? Well, the point is they're highly leveraged. They've got large mortgages, and their incomes are not really up to servicing the mortgage at the moment. As you pull out, again, you can see the high numbers. And there are some where, like Cottesloe, Peppermint Grove, not too much of an issue in terms of the numbers. But if you go to Wanneroo up north, that's a real hot spot. And some of those new growth corridors, again, the same issue. And if you go south, you can see some of the same things there too. So it sort of tells the story quite powerfully, in my view, as to what's going on. North and south of Perth, the numbers of households with difficulty, even in the West, even in where the lockdowns aren't really very strong, are actually quite significant. Now, I will just switch quickly to rental stress. Sorry, that's investor stress. Let's go. Oops. I was going to do that one. Rental stress, there you go. So just quickly, this is New South Wales. You can see a lot of rental stress right in the centre of town. That's because, of course, there's a lot of people renting close in. And as you come out, you can see that there are some hot spots. You can see the Bondi area again showing up. Some rental stress over in the west, but not as much as in the mortgage stress belts. Not so good perhaps coming south, but then as you pull out a bit further, you can see the same old coming up again. And it is a bit of a similar pattern. So where is the rental stress worst? Places like Blacktown. Go down towards Liverpool, that sort of area there. And you can see Fairfield in the middle, but it's surrounded by these high rent areas. And so, once again, there is a correlation between what we're seeing in terms of lockdowns and what we're seeing in terms of numbers. And I think that's quite significant. Now, I can do the same in Melbourne, just because it's quite useful to make that comparison. Okay. So if we pull out Victoria 3000, we have issues in that sort of central business district block. If you pull out around Docklands, you can see that they've got issues there, Port Melbourne, and so it goes on. And once again, if you pull out to a wider view, you can begin to see precisely the same issues, both to the areas to the east and to the west of Melbourne. But this is a very interesting comment. You can see here this massive splurge of rental stress in Wyndham. And so that means that there are property investors who are really struggling, not surprisingly, simply because the rentals are not being paid because the people can't afford to pay them. So there is a pretty strong correlation in my analysis of some of those things. Right, I could do more mapping, but I won't at the moment. If there's a particular area you'd like me to map to, I can do that later if you ask me. But I will just go back to finish the next part of the presentation, and then I'll ask some questions. Stress mapping, done that. Scenarios, just to update you. I haven't done a lot of work on the scenarios yet because there are too many moving parts, but I have made some changes based on the modelling. And that is that we think the mortgage stress is more likely to be higher for longer, the losses are going to be higher for longer, and that the home price movements in what I call the best case scenario, in other words, the vaccine rollout does work and we get this thing under control, has a 50% weighting, and there is still here a path, even through this particular scenario, there is a path for prices to rise higher than where they are, particularly for standalone standalone houses on good blocks close into the cities. Much less so further out, and very much not much going on with regard to high rise. So I think high rises are likely to fall further. But 50% weighting, I think the RBA is way too optimistic. And if their numbers were right, which is 4.5% or lower, then mortgage stress would be very much lower, and the losses would be lower, and then home prices in that scenario would be significantly higher. But I give that just a 10% weighting. The other one is that things don't work out and we get a longer term crunch, and in that case scenario there's definitely a downside scenario for properties. And when I do my modelling, I basically do it on the most 3 weighted scenarios. Now, in terms of the postcode tool, we do have that online, and if you want to do postcode, we can do that, but I'll switch back to that a bit later as necessary. And I'm going to have a look at some of the questions and see what questions you've thrown me, and I'll try and answer them and then go from where we are from there. Okay. What have we got? Interesting from Yogi Bear here. The Mortgage Keeper, a good 2020 meme or future government policy? Well, I think, look, you've got to understand most of what was done last year was actually to do with Bank Keeper. This was about making sure that the banking system was strong. They gave them massive amounts of money, the term funding facility, and up to 200 billion. They didn't quite take all of it, but then they parked it all back at the central bank. So in fact, the central bank is sitting on more than they gave the banks in the first place. That also, by the way, means that those banks now can incorporate that into their capital structure. So the capital costs of the banks have been reduced. In addition, of course, APRA gave them a free pass with regards to the loan not being measured as defaults and those sorts of things. So in a way, all of this is more to do with keeping the banks safe and secure rather than individuals. And if you look carefully, as I've done, some of the people who actually had those mortgage holidays last time around ended up with a bigger mortgage because the interest was rolled up, and in some cases the mortgage will go on for longer, which means the banks will make more money off it. But it's not necessarily been very good for many people. So to my mind, what they did last time was not necessarily a particularly smart strategy, insofar that what it's done is it's made the point to the broader industry and the investors that the government will always protect the banks' backs, whatever the cost. And just think about whatever the cost, right? We know that the amount that they actually threw on the economy a year ago was massive, and we know that a lot of that went to the wrong places. We know that JobKeeper and Job Seeker perhaps wasn't paid always where it should have been paid, and on the other hand, people got it when they shouldn't have. So there's a lot of wasted money, and I noticed that the Treasury has, I think, has a disagreement with Frydenberg about whether there should be an inquiry about looking at this. Nobody wants to turn the stones over and see just how much was wasted. So huge waste. So yeah, so I think we will see more support for households. We will see more support for the banks, and way more support for the banks, because they do not want the banks to be in any difficulty at all. And Joe said, yeah, there are some numbers, some really stunning numbers in this data. And the point about this is it tells you, remember what I'm doing here is I'm looking at people's cash flow, right? Money in, money out. That doesn't mean they're going to fall over tomorrow afternoon. But what it does mean is that they've got a lot of pressures on them. And now, of course, the pressures have built even more. And unfortunately, in some cases, these financial pressures then lead to societal questions. And, we find that people behave differently under pressure, and relationships get pressurized as well. So there are consequences, there are social consequences for what's been going on. George said this, 2 houses in my street no longer renting, surprise, surprise, yet we're seeing a lot of that. So there are a lot of properties that were renting. In some cases, they've not been able to re-rent them, or they've actually withdrawn the renting so that they can sell them to try and actually cut their losses. Remember that more than half of property investors lose money at the moment on a cash flow basis. And sure, they can say, well, there's a bit of capital appreciation if you're lucky, if you've got the right sort of property, not high rise, but if you've got low rise, or if you've got a house on a land plot, possibly you can see some capital appreciation. And that's why some investors are saying now's the time to get out. So I expect to see more listings. What else have we got? George again, banking is the best business in town. Yep. Basically, it's supported by the governments around the world. It's supported by central banks. It's amazing, if you look at their leverage ratios, in other words, how much capital does a bank actually have itself relative to its business? It's very small. So it's a highly leveraged business, highly supported. And just go back, global financial crisis, other than Iceland, no bankers went to prison for all of the stupid stuff that was done there. And there's plenty of stupid stuff going on now. Just look at some of the ratios and rent ratios and loan stuff going on at the moment. All right, Master Singleton, you've given me a list. Okay, well, we can start the list. Let me just get this sorted out so I can go there. There we go, put that up. All right, so what I'm going to do is I'm going to switch over to the information portal. Now, this particular portal that I'm using at the moment is a slightly customized view, but this is the information set that's available if you subscribe via Patreon. And I'm going to put the first one from Master Singleton in, which was 2134. I wish I could type. 2134. Okay, this is Burwood. Okay. So this is the story of Burwood at the moment. Hopefully you can see that okay. I might just try and make it slightly larger. There we go. Nice little touch now from the developers. We can actually make the text a bit bigger, which makes it easier to see. Okay, so this is Burwood. 6,000 households, 1,200 borrowing, 3,800 renting, 2,900 properties for rent, and around 2,600 property investors. The overall financial stress metric, which is the aggregation of mortgage, rental, and investor stress, is 72%. That's very high. And if you break it out, mortgage stress, 56%, which is 136 in mild stress, but look, 544 in severe stress. So severe stress are people who are well underwater from a cash flow perspective. Risk of default, only 32 over the next 12 months, but that's 3%. Rental stress, 71%, that's 2,700. And stressed investors, again, very interesting statistics around stressed investors. We split them out between the total 955 and the severely stressed ones, which are 726, which is 64%. So that shows me that, looking at it from the other perspective, there will be a lot of property investors thinking they want to get out and sell, so expect more listings to come on. We're also seeing mortgage stress high, so expect to see some of those having to sell as well. And this is the modelling. Now, this is, of course, based on the point-in-time view, but then looking over the next 12 months in a cumulative sense. So in the best case, we are still seeing some price rises, but not dramatic. And there could be a bit of a wobble. That wobble is being created by the lockdowns. Now, the assumption I've got in my modelling at the moment is the lockdowns will be here until Christmas. Now, that may be a bit pessimistic, but for the optimistic case, that's what I've got. The next one is that basically we continue to go into next year, and the borders remain shut for a lot longer. And the worst case scenario is that we get this huge surge in infections and basically the economy falls to pieces. Units, a little bit of upward side at 1.8 over 3 years, but the neutral case is a fall of 4% over 3 years, or the worst case 11%. So there isn't a huge amount of upside here at the moment, in my view, other than there might be some distressed sales. So there you go, that was 2134. And then you ask for 2135, which we can do, 2135, Strathfield, again, inner Sydney. Now, Strathfield's a bit different, so this is the latest story on Strathfield. Let's just go there so you can see it. Yeah, 8,800 households, 2,300 borrowing, 4,500 renting, 3,500 properties for rent, and 2,500 property investors. 48% in financial stress, so not as high as the previous one. Mild stress, 338, severe stress, 675. So quite a few people under significant pressure. And by the way, a lot of these have come out the woodwork because of the lockdowns. 43% in mortgage stress, 3% of defaults at 76. Rental stress at 49. And the property investors, 49%. Which is just 239 severe stressed. And here we are seeing rise of 4 or 5% over 3 years, best case for houses, or about 3.3% for units. Worst case, both negative and, you pay as your money and you take your choice with regard to the scenarios. 2220. 2220. Hurstville. Interesting question, that one. A lot of high-rise in Hurstville, of course, as well as a lot of older-style properties. 11,000 households, 3,700 borrowing, 5,700 renting, 4,300 properties for rent, and 4,400 property investors. 55% in financial stress. Mortgage stress, not too bad, 15%. although there are a few in severe stress thanks to the lockdowns. 2% defaults, 81. The renting stress is a problem though, 65% at 3,745, and investor stress at 56%, with those being severely stressed. So once again, what we're seeing is a lot of this high-rise stuff coming on the market, can't find people to rent them. And I was talking to someone the other day in this very postcode who was basically telling me the story of the fact that he got 4 or 5 units in a couple of high-rises. And of those 5, he had 3 that were vacant, and he hadn't been able to find anybody to live in them. And they were casting him an arm and a leg because he was still having to pay out, of course, all the service charges and also the strata fees. So that's an example. High-rise in these areas, very difficult at the moment, particularly, of course, without migration and with the borders closed. Okay, so that's that one. Gee, you put a lot in. 7310. Okay. So places like Aberdeen, Devonport, 12,600 in the area, 4,200 borrowing, 5,500 renting, 4,200 properties for rent, and 3,400 rental property owners. Only 13% in financial stress. That's pretty good. From mortgage stress, 12% in mortgage stress, 522. Small level of defaults, 15% in rental stress, 847, and 8% of investors in difficulty. And as a result of that, we're looking price rises of 12% or thereabouts, tailing back just slightly, best case for houses. And units, there aren't so many units, but there are a few, 9% at the peak, and then a slight reduction later is what we're seeing in that one. And the last one, 7050. 7050. And just a shout out to the developers for continuing to work on this application. We've got a lot of plans to add other functionality in it, just that I've been rather busy doing other things at the moment, so it's a bit slower than I hoped, but I will talk about that on another show sometime. Okay, 7050 includes Kingston and Kingston Beach, 5,400 households, 2,100 borrowing, 2,100 renting, 1,600 properties for rent, 1,500 rental property owners, 33% in financial stress. Mortgage stress of 53%, 1,164, 3% default rate, 70% in rental stress, 16% in investor stress. So the real issue here is mortgages and mortgage repayments. There are some people struggling. And in terms of modelling, we're thinking a 10% rise in home prices over the next year or two, coming back slightly. Units, 8% over 2 years, and then coming back slightly. Okay, so there you go. That's how the situation looks in that data point, Master Singleton. So you've got a treat there, a full set, as it were. Hope that was of helpful to you. Cookie Boy is saying this. Whoops, let's go that to there first. Press that there. Could you please press that commercial for lease comparisons now? Last year, a lot of landlords simply given up a tenant. Yeah, I've got some data on that. I just haven't accessible at the moment. I will make a show on that because we are seeing a real big problem here, particularly in the retail sector. More and more properties are just coming up for lease and just not getting re-let. And in fact, more businesses are actually looking to fold. The support this time around from both the state and feds in New South Wales is insufficient to keep them above water, and we're seeing that in some other states too. So it's interesting. I've had a few people send me photographs of strips of retail property where you've just got for lease, for sale, for lease, pretty much the whole way down. And unfortunately, that's a problem. A lot of those, of course, are held by superannuation funds, so I wouldn't be surprised to see some problems there later on. All right, what else have we got? Raymond posted this. Anyone want to buy a slightly used casino in Melbourne? Dan will consider all offers. Yeah, that's looking pretty bad, isn't it? Pretty remarkable what's gone on there with the casinos. And I guess the question we've got to ask ourselves is, has it all come out in the wash, or is there more to come? Watch this space. Interesting comment from Matt. If you let the market do its thing, prices wouldn't be so high, wealth effect wouldn't be as bad. You're making a really important point here, Matt. We are in the situation where we have a highly manipulated property market. It's manipulated by central banks, federal, state, other actors, such as those in the construction sector. There are too many vested interests all sticking their oar in. That was why I made the point earlier on about the elephant trampling the economy, right? This is not a fair market. It's not an open market. It's not an unrestricted market. It's completely dominated and controlled by ideological viewpoints. And basically, at the moment, the only game in town is to pump property prices higher and to encourage more people to take on ever more debt. And unfortunately, at the moment, we've got the situation where that debt is coming home to roost for a number of people, as I showed you in the data. And what I'd make the point here is it's not just Australia that's doing this. New Zealand is doing the same. In fact, in some ways, New Zealand's even worse. Look over in the US, look over in the UK, and other places too. There is a repeated pattern of failure of policy. And it's unfortunately linked to a particular ideology about household debt and debt servicing and all those things, and the way the banks are actually thinking about managing their business, because basically it's cheaper for them to lend for mortgages than it is to lend for businesses, so they prefer to do that. That's why many businesses have great difficulty getting any type of lending. One of my big bugbears is the issue of how do you actually get SME supported. We need real businesses, growth engines, not just more houses, because the wealth effect is completely artificial. It's not real at all. Now, if you time it right and go in and out of the market, you might be able to make a bit. But this is no way to run an economy. And as I said, I think on a show the other week, I think this is a really good quote. In New Zealand, they were saying, somebody wrote, what we actually have in New Zealand is a housing market with a little economy bolted on the side. And in a way, we're not far different from here. Okay, we have resources at the moment, although whether iron ore will keep up the promise into the future is a whole interesting question. Okay. What else have we got? You have to explain this one, Cookie. Postcode check, Sydney Harbour. How much is water in those days? Yeah, well, it's around the harbour. We don't actually measure mortgage stress in the water itself. So it's a limitation to the mapping tool, I get. Okay. Vincent says, definitely K-shaped recovery. Yeah, that's exactly right. So we are seeing a lot of households doing reasonably well at the moment, particularly those who got the handouts the first time round, are still working, can work from home, and they are actually doing pretty well. But it's the ones who are not. It's the ones who are in partial part-time work, the ones who've got the big mortgages, the ones struggling. And it's this bifurcation that we're seeing. And unfortunately, it's not uniformly spread across postcodes, it's not uniformly spread across the country. And there is, unfortunately, a political alignment between the upper end of the K and, a focus on that. And who's looking after the lower leg of the K? That's the really interesting question. Which political party or parties really cares about the battlers, about the strugglers, about the ones who are finding it really tough? I can't point to really much at the moment. That's a worry, because it means that those people don't really have a political voice. And in fact, segue into next week, I've got a political conversation next week about how we change politics to try and actually address some of these things, because ultimately this is a political construct. This is an ideological position that we've got ourselves into. This isn't just pure economics. So it is worth thinking about. Interesting from Yogi Bear, where Perth is feeling left out. We're locked down in a couple of weeks. Well, it'll be interesting to see. I was reading an article the other day, and they were saying, did you know that when we had the pandemic a century ago, the flu pandemic, the strategy for Australia was then to lock the borders and effectively keep the thing out, right? And that worked for a period of time, but then ultimately it did creep through, and ultimately we had it over 2 or 3 years as a result of that. And people died. And we're doing the same again, really. What we're doing is trying to put the borders up but then of course it breaks through. And the question is, are the borders to Western Australia strong enough to keep it out, or will that ultimately snuck in? I guess you could ask the same question of New Zealand too, because they've done quite well until quite recently. We'll see whether they continue. Interestingly, I was talking to somebody today, you can still get a flight from New Zealand to come into Australia if you so choose. You can't go back, but you can come one way because, of course, the people from New Zealand are clear of the virus at the moment, so that's quite interesting. Okay, Joe has asked for some postcodes. Let's try and put that up. Okay. 4300. Oops, sorry, I missed that. 430. Yep. Okay, Queensland 4300. This is like Belwood Park and places like that. I'm going to take your chat off so that we can see. 19,000 households, 9,000 borrowing, 9,000 renting, 7,000 properties for rent, 6,800 rental property owners, 69% in financial stress. That's quite high. 49% in mortgage stress at 4,615. No severe stress. And the 2% default rate just over 200. 65% in rental stress, 6,200, and 42% of investors in difficulty. So that's the backcloth. Overall, though, we are still looking for a price movement of houses up 11% over the next couple of years, whereas units up about 7%. In the best case scenario, the neutral and bearish case, of course, are negative, and that's consistent with what we're seeing elsewhere. So there you go, 4300. Now the question is there a 4301? I don't know. Yeah, there is. Okay. There you go, Joe. 4301, which is Collingwood Park, Redbank, 9,500 households, 3,600 borrowing, 5,300 renting, 4,000 properties for rent. Number of rental property owners, 2,300, 65% in financial stress, with 48% in mortgage stress at 1,770 and 2% at default, 70% in rental stress at 3,757 and 31% in investor stress, of which 99 are severely stressed and 635 are stressed. So again, quite a high stressed area, and we're looking there at price rises of 11 or 10 or 11% for houses and 8 or so percent over the next couple of years for units. A lot of these are actually in some difficulty now because the cash flow processes around small businesses just aren't working. We've got a lot of people who are still not doing the hours that they wanted to work, and it's really hitting home pretty hard. All right, I'm then going to do 4306, which is inner suburbs of Brisbane, places like Amberley, Blackbutt South, Mount Stanley, 13,000, 7,100 borrowing, 3,900 renting, 3,000 properties for rent, and 3,300 rental property owners, 47% in financial stress, so it's not quite as high there. Generally, you often find that when you move away from the coast, it tends to come down a bit. 54% in mortgage stress, so that's still very high, 3,900. Some default, but not dramatic. 50% in rental stress, 10% of investors struggling at the moment, and price movements 12% or thereabouts over the next couple of years for houses, and about 9% for units. So that's the story there. Okay, Jason asks, thank you very much, Jason, for your question. Put that up. How does 4873 look? We'll find out. And I appreciate the contribution. It's greatly received. It really does help. Just to explain, anything that we receive by way of contributions go directly to support the development of the content that we do here. None of it goes into any other back pocket or anything. It all goes directly to invest in the platform and everything else that we do. Okay. 13,000. This is Amberley, Banks Creek, Mount Stanley. Oh, have I done this one? I haven't got the wrong one in, haven't I? That's why. 484873. Yeah. Look it up. 4873. Sorry, I pushed the wrong button there. Or I didn't push the right button, whatever you want to say. Okay, this is Mossman up in Queensland. 3,366. 964 borrowing, 1,600 renting, 1,200 properties for rent, 1,300 investors, 32% in financial stress, 33% in mortgage stress, that's somewhat lower, 321. Bit of default, but not a lot, 36% in rental stress and 13% in investor stress. And price movements, 14% over the next couple of years. Best case for houses, 11% to 10% for units. Not quite so good for the other scenarios, of course, but that's a pretty strong growth trajectory. And let's make the point, actually, I will just make the point here that this particular tool does allow you to filter different locations and compare one with another, right? There is a compare function. And that means that, say you're asking, where are the most stressed postcodes, right? Because that might give an indication of where there might be significant value, or where are the biggest price changes in terms of value growth. Those are questions that this model can answer. Now, it's indicative, of course, because things change, but nevertheless, it's a pretty, hopefully, useful tool. And I have a number of people who subscribe simply to be able to get that information, to be able to use the tool on an ongoing basis to make comparisons between different buying decisions. And as part of the integrated process of trying to make good purchasing decisions, it actually can be, I think, quite helpful. That's what I've been trying to do. I've been trying to build a tool set that is unique and different from anything else that's out there, because there are lots of other different types of tools out there for different things, but there's nothing that does what we do, which is to use the stress and other series data from household surveys to try and get a read as to what is really going on. Okay, now Daz has asked for 3021, which I can do quite happily. Just put it in and then I'll switch across. 3021. Yep. St Albans in Melbourne, places like that. Right, let's switch across. Let's get rid of that. Okay. 19,700 households, 6,300 borrowing, 8,300 renting, 6,200 properties for rent and 6,300 property investors. Financial stress metric 37%, so that's a lot lower than we've seen in some of the other areas. 45% of households in mortgage stress at 2,800. Default at 3%, 164. 37% of renters struggling with rental stress and 24% of property investors, with 134 of those in severe stress. And if you look at the growth rates, we're looking at 6 to 8% for houses over the next couple of years, compared with units at about 6% over the next couple. In our best case scenario, the other two cases are not as positive, of course. So this is a postcode where there is still some opportunity, where we have some mortgage stress. We know that some of that's to do with lockdowns. We know that some of that's to do with part-time jobs and all that sort of stuff. We also have some renters struggling a little bit too. But overall, the investors, relative to others, are actually a bit different. Okay, what else have we got? Sam. Tamworth. 2340. Yeah, could be interesting actually. 2340. Yeah. Okay, so that's including Tamworth, South Tamworth, and a few others. Okay, 21,000 households in the area, 7,200 borrowing, 10,100 renting, 7,800 properties for rent and 7,100 property owners. 69% in financial stress, so that's a high metric. Mortgage stress at 69% with 5,001 in fact. And the default rates at 3%, so that's 199. 70% in financial stress for rents and 42% for the property investors. So some difficulty, and that's again, it's all about income and a lack of it. Growth rates, 2 or 3% over the next 3 years if you're lucky for houses, a bit less for units. Debt and regret. Missed my first super chat. 4270. 4270, sure, can do that. Whoops, what happened there? 4270. Tambourine. All right. Just going to get rid of that so you can see it. Okay, so 1,300 households. 971 borrowing, 360 renting, 273 for rent, and 321 property owners, 26% in financial stress. So a little bit less than some others. 38% in mortgage stress, 3% defaults. Can't see much rental stress and can't see investor stress. So it's a pretty good result really there, insofar that it's mostly mortgage stress, and you can see there that the growth rates are quite strong too. So we're looking at 15% over the next 2 to 3 years for houses. And units, 11%. There aren't that many units, of course, in the area, but there are a few. But the point there is this is a much more interesting postcode than many, simply because of the fact that stress is low and the upside is quite a lot stronger. So one to look at possibly if you're thinking of purchasing. Let's go here. Electro-fried. 4551 to start with. 4551. Okay. So this is Bells Creek, Golden Beach, Kings Beach, Pelican Waters, Shelley Beach. All very good. And 26,600 households, 8,300 borrowing, 12,300 renting, 9,300 properties for rent, 7,500 rental property owners, and 36% in financial stress. And mortgage stress is 25%, that's 2,000, not too bad. 3% defaults, 43% in rental stress. So again, rental stress is a problem, and that translates to a bit of investor stress at 31% too. And looking at the growth projections, we're looking at 13 or 14% over the next couple of years for houses in the area, and 9 or 10% for units. That's the best case. The others are obviously less bullish. And then you wanted me to revisit Gympie, which I will do. And I realised that I've just covered up the... let's take your chat off. Let me just put that back up so everybody can see the numbers that I read out. Okay, and then let's just go to Gympie 4570. I can't easily compare it with last month. I mean, there is a way of doing it with this tool because you can actually look at trends and things, but I just don't have that data readily to hand at the moment. Okay, so this is 4570. 18,700 households, 6,700 borrowing, 7,500 renting, 5,700 properties for rent, 8,100 investors at 40% in financial stress, 22% in mortgage stress, 1,500, 3% defaults, 42%, 3,211 rental stress, 36% for investor stress at 219. Note that's severe stress. And the growth rates in terms of prices, 12% over the next 2 or 3 years for houses and about 9% for units. And thanks very much for your contribution. I appreciate it. Okay. Very good. Cookie Boy says Robbie Barrett wants a postcode check on Beijing. Any luck? Well, I'll tell you what, China's locking down. They've got the variant over there. So very interesting to see what happens. I was listening to a report today saying that Wuhan has been locked down for the first time for a year. Not good. Paul says, well, so who are those people who are actually considering buying? There are some still buying, you know, even with all of this heady information about where prices are and everything else. It is surprising, but true. And, of course, people still believe that prices are going to go on up. Well, they might, but there are some other scenarios that are less positive, of course, as well. So just bear that in mind too. And I am not saying you don't buy, but you should make sure you get the full information, right? You should look at my data and you should look at the price trend history in the particular area and look at the type of properties and do all the other work, because you can easily make a mistake at the moment. And there are a lot of people, in my view, making mistakes. Luke asks for 2259, which we can do. Hopefully, if I can find 2259, yep. 2259, which is, I'm sort of getting to know the postcodes, but I don't know all of them off by heart. So they're always a nice surprise when they come up and I find out what we're talking about. It's quite interesting. One way to learn more about geography of Australia, I guess. 23,500 numbers of households in Chain Valley Bay, Torrawong, places like that. Lemon Tree, some nice names. 9,900 borrowing, 8,900 renting, 6,600 properties for rent, 8,400 rental property owners, 52% in financial stress. So that's in the middle of the road. Anything above 40 always worries me. 39% in mortgage stress at 3,800 at 3% default. 63% in rental stress. So again, same pressure on rents, 5,600, and 39% of property investors. And the property investors are in the severe stress. Now, just to explain, severe stressed investors mean that they haven't got occupancy in the property at the moment, or they're trying to sell it and have been unsuccessful, or they're in negative yield. So any of those different scenarios. In terms of price growth, we're looking at 4 to 5% over the next 3 years, best case scenario for houses, and about 3% for units. The worst case scenarios, of course, are underwater. Okay, I'll do one more and then I'll look at some other questions then, because we can do more than just look at postcodes if you're interested in other questions. I've got one or two things I want to talk about as well. So 3029. 3029. Okay. Tarnet. Hoppers Crossing. Yep, 30,700 households in this area. 18,100 in borrowing category, 11,200 renting, 8,500 properties for rent, 9,800 investors, and 53% in financial stress. 6,500 in mortgage stress at 36%, 2% or 457 risking default over the next 12 months. Rental stress very high, 71% at 7,969. And stressed investors, 596 at 24%. And I've mentioned this before as a high growth corridor. We do see a lot of pressure here, a lot of people struggling. And, you know, that said, the truth is that there is potentially still some growth, but not dramatic growth. So we're saying 5 to 6%, 7% over 3 years for houses, if you're lucky. Units about 5% over 3 years. The worst case scenarios, of course, are significantly more adverse. Okay. What else have we got? Make sure that I've seen all the... Let's go over there a second. Just activity. What else have I got? Map of Tassie from Dad from earlier on. Yep, let me do the map. I'm trying to keep track of all the various chat streams and everything, and just to make a change. All right, we're going to do a map of Tassie here, and we'll start with rental stress. So let's go to 7,000. That should take us to Tassie. All right, so I'm looking at rental stress in Tasmania first, just because that's an interesting place to start. I'm looking at Hobart and going out from there. And you can see that there's not a lot of pressure immediately obvious in terms of rental stress at the moment. There's a few hot spots. Right? If you pull out a bit further, of course there are some white spaces where there isn't much information available. We can just look at the top part of the island, go up towards Launceston, and just do a little drill there and see whether there's anything there happening. And the answer is not a lot. So rental stress, not particularly worrisome. If we go then to mortgage stress and do the same trick. So mortgage stress again. Now remember, I'm looking at numbers here, and of course by definition the numbers are lower in Tasmania because the numbers of people in the location is a lot lower, so you wouldn't necessarily expect to see so many as some, but you know, there's still some slightly interesting numbers in some areas, like this postcode here, for example, which you can map back to the scale there. And so sometimes I present this information in percentage terms, which gives you a rather different way of looking at the information. But for the purposes of today, because I wanted to make the point about the correlation with lockdowns, you can see that there were some issues. Now, some of the West Coast, some issues there, possibly. And if I go up to the top end and drop back into Launceston, here you go. So you can see there's a few postcodes with some issues. Others where there's really not much showing. So I hope that's of some use to you. And then Travis asked for 2630. Now, have I done 2630 is the question. I don't remember. So we'll have a look. Bear with me a second. I have to get the developers to create me a table of ones I've done. Nope, a new one. So this is Cooma. Okay, Rose Valley, Rock Flat. So it's sort of, yeah, down here, right? So this is Eden here on the south coast, Bateman Bay, Canberra's over that way somewhere there under the logo. 4,300 households, 1,300 borrowing, 1,900 renting, 1,400 properties for rent, 1,150 rental property owners, 58% in financial stress, 60% in mortgage stress, 813, a default rate of around 3%, 64% in rental stress, and 44% in investor stress. So there is a bit of shenanigans going on there, really. Overall price growth, 3 or 4% over the next 3 years for houses, and 2 to 3% for units. Not that many units, but some. So there you go. That's that one. Another interesting question. Let's see if I can get that on the screen. Let's go there. Quite a lot of different things. Considering buying in 3121, can you shed some light on how the high inflation scenario helped me? Yeah, okay, well, let's have a look, shall we? 3-1. I can't do a full one-to-one on that on this show, but if you want to go into deep detail on it and look at all the properties that are there and what's driving them and all that sort of stuff, that is the purpose of the one-to-one show. But we can look at the overall data. 15,800 households, 3,900 borrowing, 10,000 renting. So this is a highly rented area. 7,800 properties for rent, 4,900 investors, 47%, so slightly above middle of the road in terms of financial stress. 30% in mortgage stress at 1,200, 3% default rate, 39% or 4,000 in rental stress, and 48% in investor stress. So my read is that there are some significant issues in terms of the rental sector, some mortgage issues, not dramatic, price movements, looking at about 8% over the next 2 or 3 years in terms of houses, units, about 5% in the best case scenario. In the worst case scenario, a drop of 9% for houses and 7% for units. And thank you for your contribution, it's greatly appreciated. So, no, not necessarily. It's all about price, right? If you can actually figure out what the true value is for a property in the area, there is never a completely idiotic time to buy a property. Also depends whether you're buying for investment purposes or whether you're buying for an occupation, right? Because the owner-occupation formulation is very different from the investor formulation. And quite often what I find when I talk to people about their intentions is they're a bit confused between the two, right? Because an investment is about a financial return over time. If you're buying for an occupation, it's more about the place you want to live because you want to live there. It's shelter and all those good things. People contaminate the two thoughts, and to my mind, they aren't necessarily quite the same. Now, I want to just do this. I have remembered tonight to push my button. So this is the view of the studio from another camera. The reason I've shown this is because I often forget. I always have the other camera set up, but I never remember. So there you go. This is the studio. This is how we're all making it work at the moment, if you're interested in that. You can see me at play, as it were. And then you can see me with the green screen behind, so it all disappears into the background again. And just going back to Jubal's question, will a high inflation scenario help me? High inflation, think about it. If you get high inflation, interest rates will go up. They'll have to tame it. If inflation goes up, rates go up, mortgage repayments go up. That will put you under significant financial pressure. So whilst on one hand you might argue that inflation will inflate the debt away, it won't necessarily inflate the repayments away. It'll actually make it more difficult to repay. So yeah, be careful what you wish for. This inflation stuff can be quite wicked. Remember, there were people a few decades ago paying 17% on their mortgages. 17%. You do the calculation, right, compared with 2 or 3% today. So if mortgage rates go up by 1 to 1.5%, about 30% of people with mortgages would be unable to make their mortgage repayments in my modelling. So we've got a lot of very, very much in debt people. Okay, what else have we got? Are you ignoring 2325? No, not really. I've just got too many. I got too many on the list. I always have this problem. Too many people. 2, 3, 2, 5. There you go. Only. Another interesting example of a place I didn't know, with Bellbird and places like that. Okay. Wollongby. Ah, there you go. 11,700 households, 4,200 borrowing, 5,000 renting, 3,800 for rent, 2,800 properties for investors, 47% in financial stress, 55% in mortgage stress, 2% defaults, 51% or 2,500 in rental stress, and 26% in investor stress. So, rental stress, a bit of an issue, mortgage stress, somewhat of an issue. Overall price movements, we're looking at perhaps 5% over 3 years for houses, compared with about 4% for units. Again, not that many units, but more houses. So there you go, that's that one. And 2325, yep, there you go, 2325. You've definitely had that one. So, bring up the screen. Of course. My apologies. I do apologise for that. There you go. So I'll just leave that up for a second. 11,000 households, 47% in financial stress, 55% in mortgage stress, 51% in rental stress, 20% in investor stress. And just to explain, there's a 15-second delay between what I'm doing and your comments. So I apologise that I then get all of the comments afterwards, which shows you're awake. I'm impressed, and I apologise for that. Okay. Bring up the screen. I did. 3217. Okay, let's just do one more on there. This is Charlemont. There you go. 3217. So let's do 3217. Victorian postcode. Deakin University and surroundings, right? Not that many people there, of course, because of that. So this is a low read. 2,300. 51% in financial stress. More borrowing than actually renting. 47% in mortgage stress. 3% default rates. 50% in rental stress and 10% in investor stress. So rental stress is a bit of an issue. 388. Price ranges, maybe 8% over the next 3 years. For houses, units, about 6% over 3 years. Okay, well, we're coming close to the end, folks. Thank you very much to Jason for his comment there. Really appreciate it. And it's, yeah, I think I've done 2325. Yep, done that. And thank you very much for that conversation. Yes. And Yogi Bear, thank you very much for your call as well on 2325. You know, it's quite complicated. I've got so many things going on that it's just occasionally I do, unfortunately, miss things. Yeah. Okay. Joe says, can we talk about the other things you want to address? Yes, there were two things I wanted briefly to touch on just before I close. The first one, I've had a couple of questions about bail-in, deposit bail-in. I wanted to say that there is a theoretical risk of banks getting into difficulty in grabbing deposits and converting them to equity. In Australia, it's something which is not completely off the table if you look carefully at what people are actually able to do under the APRA app, despite the fact that APRA says they'll never do it. But the point I wanted to make is I think it's highly unlikely, and people shouldn't be too worried about that, because we've seen the governments will do everything they can to prop up the banks. And so therefore the risk of a bank turning over at the moment I think is quite low. So what I've said in my perspective is I'm less concerned about deposit bail-in today than I've been for the last 3 or 4 years. And we know in addition that there are things happening quietly in the background in terms of trying to change some of those regulations and things later. So I've got more to say about that in a future show, but I just wanted to cover that off because I had a couple of people ask me the last 2 shows about where I am on the bail-in story. So theoretical risk, yes. Practical risk, pretty low at the moment. AJ, thank you very much for that. I appreciate the super chat. It's Victoria says 0820 is a real postcode. Is it? We'll see. Probably is. 0820. 820. Yep. Northern Territory 820, there you go. Yeah, you're right, it is a real postcode. Let me put this up and get rid of that so you can see it. Okay, so this is the Northern Territory postcode 820. You can ignore the first 0 in the model. 9,377 households, 2,000 borrowing, 6,400 renting, 4,700 properties for rent, and 2,300 rental property owners. 18% in financial stress, so pretty low. Only 14% in mortgage stress, 15% in rental stress, and 18% in investor stress. There we go. Drew says, they're just going to keep the presses going. They are, almost certainly. How many weeks now have you done weekly? Best thing you've ever done, if you ask me. I started just before the first lockdown, didn't I? So, yeah, I can count them up. I've probably done... I've actually got 2,000 shows in the archive overall, and I reckon that around 150 of those are actually the weekly shows. So yeah. Yeah, he's found out how easy Super Chat is. That's great. Well, 2590, I can do that before I sign off. I'm going to sign off quite soon now. 2590. I quite enjoy doing these, actually. It's quite fun. 2590. Click on there. Look up that. Then switch back to that and get rid of that so you can see it. There you go. Okay, 3,400 households, 997 borrowing, 1,420 renting, 1,084 for rent, and 65% in financial stress, 83% in mortgage stress, a very significant mortgage issue with 831, 88% in rental stress, 20% of investor stress, so that's why it's so high. Property movements up, maybe 2 or 3% over 3 years, best case for houses and units, even less. And there you are. Okay, that's good. So Smooth says we're going to have a trivia question next week, which will be good. Joe says, I'd like to have a chinwag about your production setup and how you run things. The camera's audio clear. So you got a Rode mic, but are you using a different mic? No, this is the mic I'm using, this one here. That one over there is another one that I use for some other things. This is a Rode broadcast mic, and you'll see that it's just below the picture, right? If I take that off, you can see it's just out of here, out of shot. It's quite close to me. It goes into a mixer, and the mixer is got a little bit of jiggery pokery with compression and things in terms of helping to get the audio. Yes, the other thing I wanted to address just briefly was this one, your thoughts on Nuggets news. So I made a show the other night, really just to say, look, big surprise from me. I mean, Nugget and I used to make the occasional economic conversation. I'd get all the charts and slides and we'd have a discussion about it. Never detected anything that was untoward there. And in fact, I regard him as a more conservative crypto driver compared with some other people that I've touched and spoken with. But maybe he extended himself, maybe he got himself over-leveraged and thought there was a way out. I don't know. I have no inside information, haven't had any communication with him, but obviously I was very surprised and shocked to hear about him. But I did look at the shows that I put up and decided that they were perfectly fine. They stood their ground in terms of the discussions that we had, the information that we shared, and there was nothing that I regretted saying in any of those shows. So I'm leaving my shows up, and obviously I won't be doing any more. There is also the interesting question, and this is the other point that I wanted to make. There are people who've had it in for Nugget for some time because some of the positions he's taken, he's called out a number of cryptos as scams. I have no way of telling which is a crypto scam and which isn't, and that was really the purpose of my post at the weekend. Go and have a look at it if you've not seen it, right? The point is that there are lots and lots of coins out there, all claiming to be the next best thing, the greatest thing since sliced bread, the unique features, the massive returns. Well, many of those are actually only paying returns because of the staking, which is an investment strategy that has winners and losers. And it's very hard to really know whether there are good ones or bad ones and who are the winners and who are the losers. So all I say to people is, in crypto land, it's unregulated. Just be cautious and careful. I'm not saying that we should not engage in crypto and think about crypto, because I think crypto is actually all about the blockchain, and the blockchain will have purpose in the future. But be cautious. Don't just take the first thing that is thrown at you, and don't just assume that the people is telling you the truth. Sometimes we find that there are pirates there, and I can't judge as to whether that particular crypto is better than that particular one, and whether that's one a pirate and that one isn't. So all I'm saying is just be cautious, right? And that's really the message I want to leave, because the Nugget story, whether he's thrown under a bus or whether he's not, is you've got to be careful, because people are losing a lot of money as well as gaining a lot of money in the moment. Markets are moving a lot, people are actually multiplying their exposures using options and those sorts of things. And some people win, some people lose. For every winner, there's a loser. And my worry is that some of the losers are the more recent people who've come in to crypto land and essentially may not be quite up to speed with what's going on. Okay, a plea from the heart. All right, 3 out of 2. Okay, we're going to run just a couple more, just because everyone's asking, and we've still got people on the show. Cookie, you could be right. We could be aiming for sort of closer to 10 tonight. Oh dear, that's not going to help me tomorrow, is it? When I wake up late. But there you go. All right, 3 out of 2. Endeavour Hills, 8,500. And 58 households, 4,300 borrowing, 2,400 renting, 1,800 properties for rent, 2,775% in financial stress, 98% in mortgage stress, that's very high, of course, 4,200, 70% in rental stress at 1,690, and 22% in investor stress, with 154 in severe stress, and that makes it 4.8% over 3 years for houses and 3.5% for units. Okay, so there you go. Andrew says you've got to be prepared to lose the lot. Well, that's possibly the case. My problem with crypto is I have no idea how to value it. Well, that's my problem. If you trade momentum, that's fine, but momentum can go up and it can go down. There is no fundamental correlation to anything. Okay. Happy Robot, I can't show that comment. Bad language I won't show, so it gets chopped, unfortunately. 3690 was 3690 from Sarwan. There we are. Okay, thank you. I'm glad you liked the show. 3680. Yeah, that's interesting. 3690, is it? Yes, I mistyped it. Okay. Three, 6, 9, 0. Something is not quite as it should be at the moment. I can't get that one to come up. Why is that? There you go, done it now. Yep. Okay. Here we come. 14,600 households, 5,300 borrowing, 7,100 renting, 5,400 properties for rent, 2,400 rental properties, 40% in financial stress, 58% in mortgage stress at 3,000, 30% in rental stress at 2,000, and 24% for stressed investors. Price movements 8% over 3 years, maybe for houses, and 6% for units is what I'm seeing. Okay, one more. This is the last one I'm going to do from Madam Butterfly. 2,777. I can't resist good music. New South Wales 777, 6,700 households, 3,500 borrowing, 1,600 renting, 1,200 properties for rent, 2,100 property owners, 22% in financial stress, 21% in mortgage, 21% in mortgage stress at 729, 24% in rental stress, and 19% in investor stress. And the price is 8% over 3 years, best case for houses, and 6% for units is what I'm seeing. Okay. Okay. Happy Robot says it ends when we say no. Okay, take your point, but very interesting. Actually, my wife's the doctor. I'm not. But just to be clear, although she gets a bit cross when I get called Dr. North. Okay. And Nicholas says, poorest families are suffering the most. Yeah, that's really an issue. You know, the thing ultimately I come to is that it's unequal. The egalitarian view of Australia that we had years ago is definitely dissipated, unfortunately. Anyhow, thanks for the fantastic show, says Electro. Thank you very much, and appreciate all of those who have contributed. I think I've called out most, but just to give a heads up to Travis, to GT Kennels, AJ, Jason, Yogi Bear, Jubal, Travis, Dad, for a list there of thank you. All of those for making a contribution via the Super Chat. Really have appreciated it. I'm just going to close the show out by giving you just a couple of last views of information. Just going back to that particular chart there. Okay. So if you want more information about what we do and how we do it, you can always go to walktheworld.com.au. It tells you all about what we do and all the things that we get up to. You can also go to the DFA blog if you want to get more information, if you'd like to subscribe. You can do that on the blog and get updated every time we make a post. A lot of information there. You can support our work via Patreon, and as I mentioned, you can actually get the stress data, access to the series that I've shown you today, plus a lot more for US $50 a month plus GST. And you can make a contribution via PayPal if you'd like to do that to help us with what we do. There's a lot of costs in what we do. We do this because we believe in the information and sharing, or indeed you can make a contribution via Bitcoin if you want to do that. There's a Q code there for those who want to do that. And there's even a Merc store, which I never push very hard. Next week, I've got a political conversation, and I wanted to get somebody on who was thinking about politics in a different way. And Victor Klein is the leader and founder of the New Liberals, and I wanted to talk with him about politics in this time of COVID, when Labour and Liberal have both come on the same side of politics in many ways. What does that mean? How does a new party get off the ground? Is it feasible? What are the policies? All those sorts of things. So it'll be an open political conversation next week. It won't be just pushing a particular political party. It's a more discursive conversation about politics in the 21st century in Australia. So hopefully that will be an interesting conversation. Join me then. And I hope that you've had some good experiences on the show tonight. Thank you very much for staying with me to the end, one of the longest. And I look forward to seeing you here next time. And thank you very much for all the questions, all the comments. And I apologise if I didn't get to yours. If you have a particular postcode that you would like stressed details on, you can contact me via the DFA blog and send me a message there. There's a little chat component there on the bottom of the screen on the blog, and you can ask for a particular postcode. And if you ask me, I'll send it back. It might take a day or two because I quite often get a few, but there's a way of just keeping that conversation going. So thank you all very much. Wish you all well. Stay safe, and I hope we don't get more lockdowns. Master Singleton, thank you very much for that. Appreciate the contribution there. Thanks to Cookie Boy for the conversation. Adios. And Jeff says, when the currency is destroyed, the economy is destroyed. Yeah, probably true. And Joe, if you want to have a more detailed conversation about the studio and how it works, very happy to do that. Send me a message via the DFA blog, or you can go on to the YouTube channel, on my channel. I did a show a little while ago about how the studio works, if you're interested in that, because there's quite a lot of information there. And thanks to Master Singleton and a few others for acknowledging. Please like the show. I do always say, remember to like the show. It does make a big, big difference. And it does help to propagate it So take care. See you next time. And thanks very much for staying to the end. Martin North from Digital Finance Analytics, signing off. We'll see you next time.